defending the free market and making the moral case for capitalism. The Justin Moore Show. Hey everybody, welcome to the Justin Moore Show, where we make sense of what's going on in this crazy, insane, out of control world. Now, ladies and gentlemen, I have a very special show for you guys today. I have a guest on the show. Joining me once again is Chris Casey. Chris Casey, he's a managing director for Windrock Wealth Management, and he's also written articles for Mises.org and Dollar Vigilante. Chris, welcome to the Justin Moore Show.
Hey, Justin. Thanks for having me on.
It's great to have you back, Chris. I always love talking to you. Now, on today's episode here, this interview, I want to just mainly focus on the yield curve and what that means. What's a inverted yield curve? Because there's a lot of people out there, people start mentioning yield curves like, well, what the hell is that? What does that mean? Blah, blah, blah. And so we're going to get to that. But before we get to that discussion, you'd write a lot of articles on Mises.org talking about economics, talking about the Austrian business cycle. So for people out there who are pretty new to this, what is the Austrian business cycle and what do the Austrians have to add and explain for what's going on in the economy?
Sure. Well, I think the Austrians are the one school of economic thought that actually adequately explains why we have business cycles. And that may seem shocking where people think, well, didn't Keynes figure it out? And hasn't the Chicago School weighed in on this with Milton Friedman? But all those explanations of business cycles are seriously lacking in some components. And it's the Austrian theory that's the only one to explain it. And it's actually, you see the evidence of it in the economy as well. So briefly, it's a fairly simple theory. And that's actually one of its chief criticisms, which is strange that it's simple, but it is simple. It's simply stating that by artificially increasing the money supply, so that is by printing more dollars, whether it's banks that are lending out and creating dollars out of thin air, or it's central banks that are actually printing dollars. Once you increase the money supply like that, you have distorted a key price that's in the economy, and that's the interest rates. And when you distort the interest rates, when you distort their level, when you lower them, because you're issuing money, they're buying financial instruments like bonds, they're lowering interest rates, you have now created a false signal to economic actors throughout the economy, whether they're consumers or producers. But now it appears to everyone that long-term projects that previously looked like they would be unprofitable would now be profitable. So think of a businessman that was looking at opening just a new retail location. And if you look at projected sales and expenses and the borrowing costs, you would think, okay, this may make sense in this depressed yield economy, this depressed interest rate economy. But once yields eventually rise, all of a sudden that investment has proven to be a malinvestment. It was a poor investment. You either did too much investment or you just invested in the wrong thing. And it's this malinvestment that's liquidated in the recessions. And what makes it interesting is that the Austrian theory of the business cycle is the only one that really explains a lot of economic phenomena that we see within a recession in the boom period that precedes it. So it explains why did these all of a sudden start occurring within the 19th century on a regular basis. Well, it's not because we had the Industrial Revolution. It's because we had central banks and we had a lot of wildcat banks. We had fiat currency at that time. Why it explains why you see this boom more so in cyclical industries than in, say, consumer product companies. It's because they're more influenced by interest rates. It explains why it's a recurring cycle, which is because every time this happens, the central banks, in trying to fix it, do the exact same thing that caused it originally. So it explains all these different economic phenomena that we witness within a recession. And for that reason alone, and from the soundness of its logic, it's really the only explanation that's adequate to explain business cycles.
Okay, so the Federal Reserve, in response to the crisis in 2008, with the popping of the housing boom bubble, they lowered interest rates and they kept them at 0% for what, about 10 years? So having interest rates that low for that long, what does that mean for what's to come?
Well, it means there's more malinvestment probably than any other boom period that we've ever had. which means that the recession, when it comes next time, and just putting theory aside for a moment, we'd expect a recession to be coming fairly soon because we have the second longest expansion on record in U.S. history, and we're fast approaching the first one. I think we're only about 6 or 7 months from the longest expansion. So that means that not only have the malinvestments built up, it means that the pain will be correspondingly large. So don't be surprised if the next recession could be longer and also sharper than perhaps the '08 crisis we had.
When people start talking about trying to predict recessions, it's this discussion of the yield curve, the inverted yield curve that takes place. First off, what is the yield curve for someone who's like, okay, yeah, what is that?
Sure. And by the way, it drives me nuts whenever I'm watching some financial news program and they talk about the expectation of recessions. And there's always some analyst that makes the quip like, oh, I don't see it on the horizon. And the reason they don't see it is because they're effectively reading tea leaves, right? Unless without a theory that explains it, if they don't believe in the theory, if they don't understand the theory, then of course they don't understand or foresee a recession. It's no different than a astrophysicist not having a theory of gravity and trying to explain the motions of the stars, or a doctor not having a theory as to germ theory, and trying to treat patients. I mean, it's this is why Federal Reserve economists, mainstream pundits, all these people miss recessions. But one of the areas that you mentioned that has been very good at predicting a recession, one of these signals is the yield curve, an inverted yield curve specifically. And a yield curve is simply a graphical depiction of interest rates based on their time horizons. So visualize just a two-dimensional line graph, the y-axis, the horizontal axis, it's listing interest rates in general, the x or horizontal axis listing the time periods, whether it's a 6-month bond or it's a 30-year bond. When you graphically depict that, traditionally you will see them perhaps somewhat upward sloping. To the extent that they become flat or inverted, meaning that the short-term interest rates are larger than the longer-term interest rates, that typically has preceded a recession. In fact, every recession we've had since 1950 has been preceded by an inverted yield curve. And every time we've had an inverted yield curve, with the exception of one, this is one out of 10 or 11 inversions since 1950, we have had a recession. So in other words, there's been one false positive and no false negative. So it's a very effective predictor. And the Federal Reserve recognizes this as such. You could go to the Federal Reserve Bank of New York, look on their website, search for yield curve, and there'll be a little introduction that says this is the best predictive power that's out there.
Okay, so with that, I guess someone who's just getting into the stuff, that's like, okay, well, if the Fed and all these experts know that, then why don't they just stop it from inverting, or just because they don't understand how it all works, why don't they, because they know that this is a good predictor of recession and you want to avoid the recession, just not let the yield curve invert? What does the central bank try to do?
Well, I should emphasize that, number one, the inversion of the yield curve isn't what causes a recession. The inversion of the yield curve is simply a signal that typically precedes a recession. So there's no causality. In fact, they're basically both created by the same set of factors. They have they have the same underlying cause. It's not one creating a situation for the other. As to why the Federal Reserve, despite acknowledging that it's probably the most predictive signal out there for a recession, they consistently, and you could just go do Google searches. In fact, just a few months ago, Governor Brainerd was speaking before some association in Detroit, and she addressed the yield curve, and she said, yes, it's very predictive, but there's other things we have to look at. We can't solely rely upon it. This time is different. There's always an excuse why they don't seem afraid of it. And the primary reason, I think, is because they don't understand why it exists. They don't have a theory. Not only do they not have an appropriate theory to explain business cycles, but whatever theory they do have does not explain why there's an inversion of a yield curve. And if you look through the academic literature and there's various theories to explain why there's a flat yield curve or it inverts. The non-Austrians have a very difficult time. Every theory they put forth has some serious holes in it. So I think the Federal Reserve, they simply don't understand it, and for that reason, they're somewhat dismissive of it, even though the academic literature clearly points to it being a very powerful predictive signal.
Okay, and so to get this inverted yield curve, what year-dated bonds are we looking at when looking for this inversion?
Well, that's a good question, and today's a great day to answer it, December 4th, because I just looked this morning. There's a lot of articles saying the yield curve is inverted as of today.
Hmm.
And they're measuring it, when you dig into it, they're measuring it on what they would call the fives over the twos. So that means they would look at the 5-year bond and compare it to the 2-year bond. You basically subtract the 2-year from the 5-year. If you did that right now, or at least earlier today, it would be negative. So that would signal an inverted yield curve. There's all different ways to look at this. It could be some people look at the 10-year over the 6-month bond. I typically, and I think most people, look at the 10-year over the 2-year. So they would call it tens over twos. Mm-hmm. And if you look at that today, while it's not technically inverted, the last I looked, it was only a 10 basis point difference. So it's effectively no difference between 10 years and 2 years of lending. There was no difference.
Hmm. So when was the last time that the yield curve did invert?
Well, not surprisingly, it was just before the '08 recession. Now, just because something inverts doesn't mean a recession is imminent. There sometimes is a time lag. So, for instance, the last time it inverted, it was inverted for a while. I think it was inverted beginning in sometime in '06, consistently through '08. So it doesn't mean something's imminent, but it does mean it's coming down the road. And so that's the last time we had it. Although, like I said before, it's happened before every single recession since 1950.
So would you say the typical lag after the yield curve inverts, what it's typically, a year or two, or what have you seen looking back in history since the 1950s?
I haven't studied it, but just looking at, I've seen graphically the last few recessions how the yield curve has looked. I'd say it looks like it's at least 6 months before recession's officially acknowledged. So it may be that long, it may be shorter, and it may be a little longer. It's really hard to say.
Okay, yeah. So right now we have interest rates, they're at 2.25% to 2.5%. Do you think the Fed is going to raise interest rates in December and continue to raise interest rates on into 2019?
Well, I do think they'll raise them in December. Let me first say that I think there's an undue focus on the Federal Reserve and the rates that they control and whether or not they're raising the federal funds rate. I don't think that's all that important in today's day and age, simply because of the excess reserves that are out there. So banks, unlike before, really don't have to borrow from the Federal Reserve, and they really don't have to borrow from other banks to meet their liquidity needs. Most major banks have massive amounts of liquidity sitting at the Federal Reserve, excess reserves far in excess of what they need right now. So I think there's an undue focus on that, and I think it's has less of an impact on rates overall than it has historically. And the markets are probably a little bit unduly focused on that. So I do think they'll raise them in December. As far as what they do afterwards, I don't know. And I should know because the current chairman, Powell, is probably the easiest chairman to understand since I've been a kid. I mean, between Janet Yellen, Greenspan, and Bernanke, just listening to any of their comments, it's really difficult to decipher what they're trying to say. And like Greenspan famously said, that was on purpose, but I don't think it was for the others. So it's hard for me to say. I mean, Powell's a very plain-spoken, easily understood chairman. The Federal Reserve is strange. They always talk about a dual mandate. Well, in actuality, it's a triple mandate. They're supposed to keep rates reasonable, interest rates reasonable, inflation in check, and they're supposed to pursue full employment. But not only do they have 3 mandates, but they have another unspoken one, which is clearly that they're concerned about the stock market. They falsely believe in the wealth effect, and so they're always trying to prop up the financial markets. And so for that reason alone, I'd say for 2019, all bets are off. It really depends on what happens in the stock market. Now, that's just that what they're going to do based on raising the rates under their control. As far as interest rates in general, I do think they'll continue to rise, will rise, and primarily because one of the primary reasons being the Federal Reserve is liquidating their hoard of bond holdings that they've accumulated since '08. And so putting that much, selling that quantity of bonds into the marketplace only has a dampening effect on bond prices, which means yields go up. So again, I think it's an undue focus by mainstream media on that particular signal, but I think rates will rise. I don't know what the Fed's going to do in particular. I think really the question is, what do they do with their bond selling program?
Okay, so with Jerome Powell as the Fed chairman, do you think that he really absolutely believes that the economy is strong? Or, like you mentioned, like he's a lot more easy to understand compared to, say, a Yellen, a Bernanke, or a Greenspan. What's your take on what he thinks actually about the economy?
I do think he thinks it's okay. I think they all
That's what I
certainly
think
see
too. Yeah.
weaknesses and areas of concern, but in general, I think he does believe that the economy is strong. Otherwise, I'm just shocked at what he's already telegraphed and what he's done if he believed that the economy was weak and about to enter a recession.
Yeah, and actually, I just saw from an article today, Fed President John Williams, he's talking about the U.S. economy, that it will stay strong in 2019. He's thinking that inflation will tick up to about 2% or, stick around those levels. And he thinks that the Fed is going, or the inflation is going to remain around the 2% level for the foreseeable future. Do you think that is the case with inflation, or do you think, when is this going to get out of hand?
I don't think that's the case with inflation. Before telling you where I believe it's headed, I should just tell you that the Federal Reserve, they probably have 2,000 PhD economists working there. But despite that, or maybe because of it, I should say, they're the absolute worst at forecasting anything from given any government agency, let alone any entity out there. They're consistently wrong. And think about this. Not only are they consistently wrong with what they predict, they're consistently wrong with predicting things that they're controlling, right? So, I mean, they have a large impact on the economy. They have a large impact on interest rates. They have a large impact on unemployment, inflation, all these things. And they're the primary influencer on all of these things. And yet they can't even figure it out when they're hip deep in causing the issue to the first place. So, I think it's worthless listening to whatever they predict. They're frequently wrong, even with their ranges. As it relates to inflation, and by the way, again, just like with their refusal to fully believe in or acknowledge the yield curve, I think it's all because they have a faulty understanding of the theories underlying all these other economic phenomena. So they have a faulty theory of inflation. They don't believe they're at fault for it by printing more dollars. They think it's greedy businessmen or what have you. As it relates to where I see inflation, I do think we're headed higher simply because of the amount of money that's printed since '08. It eventually has to show up in prices. I think we're already starting to see that. And it's not because, like, for instance, people say, well, labor's popping up, therefore prices are going up. No, labor's a price just like any other good or service. So I do think we should be expecting higher inflation in 19.
And so what you kind of mentioned at the very beginning of this interview here, you're saying about 7 months. Is that what you're kind of thinking? Like that's when we could really start seeing the popping of the bubble, or what are you predicting?
Oh, you know what? That is coincidentally probably the same amount of time that you typically see the yield curve invert until the economy really is officially in a recession. I was really referencing how long we have until we tie or exceed the longest expansion in U.S. history. So based on both those factors, yeah, it's not unreasonable to think that 6 to 7 months a recession could happen.
Yeah, and I guess I know I always kind of thought with Jerome Powell, and that's what made me think that what he's doing, and that's when I really thought, okay, wow, this guy really does believe the economy's strong, because back in June, I was thinking maybe he won't raise interest rates, or maybe he'd just do it one more time in December. But then he raised interest rates, and this was in June prior to the election, because, there's a lot of politics that's played, even though they say, oh, the Federal Reserve, it's private, yada, 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 which is a bunch of BS. But by him raising rates, he's thinking, okay, the economy can handle this. We're fine. And they're using the word strong in their statements more frequently. And yeah, he seems to be a believer that the economy's strong. And Donald Trump was praising the economy. Then the stock market ticks down. Like today, I think I saw at its lowest, it was like down 700 points. So things are getting rather shaky out there. When the stock market's making big moves like this, does that tell you anything about things are about to come undone, or this? I guess we're just been in such a bull market for so long that we shouldn't be shocked by things like this happening. What's your take on the stock market and what's going on there?
It's probably the latter. I certainly don't think people should be shocked, although the stock market, is a forward-looking pricing mechanism. So we should see prices turn down theoretically before you see a recession. So that certainly wouldn't surprise me. But I'm always hesitant to read anything in any kind of daily moves. At least I try to look at things weekly, if not on a longer basis. Mm-hmm. But just to comment on what you're saying about Powell, I think an even stronger indication that they think the economy is okay is the fact that he's continuing this bond selling program. Because remember, this happened, or this was instituted or laid out before he took office, before he had control. And they've effectively cleaned house at the Federal Reserve. We have only 2 vacancies now. So we have 5 governors on the Federal Reserve Board. And they're pretty much all new. And so if they didn't believe in this program, if they didn't believe that the economy was healthy, they could have changed this when he first came into office.
Right. That's a good point. Okay, so last year at this time, what was making all the headlines was Bitcoin. Bitcoin was going like hyperbolic. It was insane how much it was growing. Like I've been investing in gold for several years now. And gold bugs talking about $3,000 gold. Well, hell, Bitcoin went up like $3,000 in a few days. Like it was crazy how quick it was going. Well, now I'm not sure. I didn't look today, but I think it's been hovering around 4,000 per Bitcoin. What's your take on Bitcoin? Is it going to come back, or is it dying? What do you think?
Well, apart from Bitcoin, I should just maybe address cryptocurrencies in general. We've been big believers of them for years. And so I clearly believe in blockchain technology. Clearly, a lot of these cryptocurrencies are viable entities and should do well. I think it's very akin to the tech bubble that we had, almost 20 years ago now, in that a lot of these companies, yes, there's a euphoria. A lot of them were skyrocketing in price, and they should not have. And there was a bust, and a lot went out of business. But there's a lot of viable businesses. So look what happened to Amazon. Yes, their stock price cratered in the tech bubble, but it's a viable business today, or at least it's healthy. And so I think we're going to see the same things with cryptocurrencies. There's a lot that are viable. We haven't really scratched the surface of the application of blockchain to various industries. I mean, when we reference Bitcoin, we're really talking about a monetary alternative, but there's a whole slew of different applications for cryptocurrencies and blockchain technology in a wide variety of industries.
Right, absolutely. Yeah, there's definitely a big future for cryptocurrencies, that's for sure. And like a lot of people, just betting on Bitcoin, but it's like there's so many cryptos out there. Like, how do you know that that's the horse that wins the race, based on this increase in technology? So now I want to transition here and ask you what you think about gold. Gold basically peaked out, 2000, or silver was like 2011. I think gold peaked out in 2012. Almost hitting $2,000 an ounce, and it's just been kind of hovering around that $1,200 level an ounce right now. Is gold finally going to start shining again, or we got more bad news ahead for gold and the miners? What's your take there?
Well, we certainly like gold. I mean, I think it deserves consideration in everyone's portfolio. I do see potentially at least one negative in the short term. And that is, if interest rates keep rising, then, of course, since gold doesn't have a yield, you're looking at what a lot of people consider a safe alternative to gold with treasuries. And so historically, increasing rates aren't necessarily very good for gold, the price of gold. However, I do think that gold should not be viewed as purely an inflation hedge. I think it should be viewed as a hedge to monetary and financial instability in general. And based on that, whether we have inflation, whether we have a significantly lowered dollar meaning some dollar depreciation relative to other currencies, whether it's some financial crisis, whatever the issue, I think gold is an excellent hedge against many of these.
I certainly agree with that. Chris, this has been a fantastic discussion today. There's definitely just people understanding the yield curve and what that means. I think that's crucial, and just to kind of get a feel for where we're at with our economy today. And yeah, with news just coming out today about the yield curve, this is certainly timely, this discussion. Chris, where can people find you and find what you're up to?
Sure. We post all of our research and articles on our website. It's www.windrockwealth.com, and they can find pretty much everything we do there.
All right, Chris. Well, I thank you for coming back on the show. It's been fantastic.
Thanks, Justin.
This is Justin Moore, signing off.